Good morning, Paolo. Really great to catch up with you here in Singapore. And so much happening on the stablecoin world, right? Because I come from the banking industry, one of the first questions I wanted to ask you, the Bank for International Settlements tried cross-border tokenized payments. Several regulators, Singapore, Canada, France, have also tried that. And also there is this initiative that the Bank for International Settlements is trying to promote, the idea that banks should issue their own tokenized deposits. Now, as the world's largest crypto player, what sense do you make of all this?
So, of course, stablecoins now are the new interesting technology. Tether invented stablecoins 11 years ago. Now, after 11 years, BIS and others, all the other banking players, they understand that this technology is extremely powerful. USDT, that is our stablecoin, reached 500 million users across all the emerging markets, developing countries. So it is a technology that is here to stay and actually can do much more than what it is doing still today. We believe that the next step of this technology is, in fact, improve the efficiency of the banking system, international settlements, online commerce, B2B invoice settlements, remittances and all that. The issue that I see is that BIS and similar are trying to create an approach from the top down. So they are trying to create a technology that they control and then they want to spread it to all the banks. But every single bank is a different jurisdiction. They are subject to different regulations. And also, there are only few countries that have regulations on digital assets. So there is a time mismatch where BIS does understand that they are losing the train and they are trying to rush it. But at the same time, not everyone in the industry, in the banking industry, is ready to adopt this technology. They are, exploring, they are asking questions. But I think that the difference between what they are proposing and what we did is actually starting from the ground up. So we actually built a user base that is made by people that are effective users that want to use this technology. And now the banks are now integrating with our technology. So it's much more organic approach than what they're trying to do on their more institutional side.
Do you reach out to financial institutions with the idea of working with them in some way or another?
They reach us. Yes, they reach to us. Yeah, now that we announced in the United States our stablecoin USAT, the demand of collaboration with us is just astronomical.
USAT, the criticism on that is why open two doors? You want a global liquidity. What's the game plan there?
The reason why we have two stablecoins, first of all, I think that in the future, we're going to live in a world where there will be 50 stablecoins, $50 stablecoins, and they should be all interchangeable with each other. You have Walmart announced that they want to do a stablecoin. You have JP Morgan wants to do a stablecoin, and all these financial institutions will likely end up doing their own stablecoins. So you still need, anyway, a mechanism to swap them one-to-one. And at the same time, for us, we built USDT for 11 years as a product designed for the emerging markets, for people in Nigeria, where the inflation rate is very high. Argentina, peso lost 98% of its value against the US dollar in the last 10 years. Turkey, the Turkish lira lost 80% of its value against the US dollar in the last 5 years. So we build a stablecoin for them. In the United States, the problem is different. Every place, people have different problems. And so you trying to use the same tool for every single place is not the right approach. You need to go in every single jurisdiction with perfect tool for that jurisdiction. People in the US they have banks, they have credit cards, debit cards, they have Venmo, PayPal, Cash App. So of course the financial rails and the payment rails in the United States are very efficient, are 90% efficient. If you go in Nigeria, the financial rails are 10% efficient. So if you bring USDT in Nigeria, from 10% it goes to 50% efficient or 70% efficient. If you bring a stable coin, in the United States, you go to from 90 to 92. If you want to go to 95, 97, you need to design it in the perfect way that is more interesting maybe a digital economy, to financial institutions. So that's why we are designing different products.
But is there a plan, like eventually, to make them interoperable or even merge them to universalize the product?
Definitely will be interoperable, so they can be swapped one-to-one in a seamless way with a very nice user experience. Basically, users will not feel the difference, but that will allow, so if you are local in the United States and only deal with the United States, it doesn't matter. You use one or the other, but people might choose the domestic one. And if you just want to send money abroad, it will be interoperable.
It'll be interesting to see how that runs out, okay? Because there's also the regulatory aspect of it.
True.
I've been listening to you speak a lot lately, and you talk a lot about financial inclusion as the raison d'etre for stablecoins. But there is also the opinion that 99%, or as high as that, of stablecoin usage is actually prop traders. Is that true? And
no. The 35% of USDT users, around the 35-40% of the USDT supply, is actually savings accounts. If you look at what is happening in Turkey, for example, or in Argentina, families, fathers and mothers of families, they don't trust the decisions of their central banks. And Argentina had 200% inflation just a couple of years ago. Now they have 40-50% inflation. Turkey last year in 2024 had 50% inflation. And they were already happy because the year before they had 70% inflation. So if you live in these countries, you work from January to December, and you end up being poorer in December compared to January. So what we are seeing actually is that the USDT users, around 50% of USDT users are not crypto users. Let me give you because all the decisions that I make are data-driven. 67% of all the transactions that move USDT, that involve our stablecoin, move only our stablecoin. Instead, 80% of the transactions that involve other stablecoins, like our competitor Circle, they move their stablecoin plus another token, digital asset. So it means that for 80% of the cases, the other stablecoin are used for trading. So because they move the stablecoin plus another asset, because it's a trading, it's a swap asset. In our case, 67% of the transaction only move our stablecoin because people use our stablecoin for payments, for remittances. Think a person that, a father, a family that works in England and then needs to send money back in Africa to his family. Person is charged 10 to 25% for sending money back home. Right. Means that 1 day per week it works for the financial institution that sends money back home. With USDT, that number is 0. Before 2020, 99% of the usage of USDT was crypto trading. Now is 50% to 60% is not crypto trading, is commodity trading, is remittances, is cross-border payments, settlement of invoices, a new digital economy. So this has changed dramatically in 5 years.
Yeah, I'm with you on that because I go to countries in Africa and I see that in new businesses being made possible because of stable coins. But I still like the idea of a lot of the use of stable coins was in prop trading, because that sort of takes us into AI, adding functionalities. If I were to throw the word AI at you, where are you taking stable coins in terms of how it dovetail with the AI economy?
So you want me to spoiler our strategy. So actually that is, I'm a technologist, right? I started coding when I was 8, I'm a sci-fi fan.
Absolutely.
Everything that I think about is, so with USDT we're covering the needs now of 500 million people, but in the next 10 years, with all the AI agents, the number of transactions of the AI agents compared to the humans will be 1,000 times more. If we think about AI as a logical being, if you have 1 trillion AI agents, they will not have an account on PayPal. They will not have an account in Wells Fargo, JP Morgan. They will use stablecoins because it's programmable money. AI is all about programmability. So we think that USDT is the logical choice because is already spread to the 4 corners of the world. works seamlessly, supports many transport layers, many blockchains, is interoperable with almost everything. And we are actually building tools to make it even easier for AI agents to interact with USDT. That, I think, is the biggest unlock that we are going to see in for USDT next year. So I'm thinking a lot about it.
Well done. I mean, this is something at the back of my mind, and I'm tracking you. Being a technology man, actually, you've decided not to be MiCA compliant. How do you translate MiCA, the European regulation, and I guess for comparison, the Genius Act? But that decision, will that close off the entire euro market to you? Will you look back in a year or two and say, maybe we should have been MiCA compliant anyway?
So first, let me explain why I decided to not be MiCA compliant. I mean, I was the only person in the digital asset industry to speak up, but I know that there are hundreds of companies in Europe that think exactly like me, but they never dare to say anything. The reason why I don't think the MiCA regulation is a good regulation is because it's forcing stablecoin issuers to keep 60% minimum of their reserves in uninsured cash deposits in European banks. And so...
Talk about boring.
The problem is we saw all what happened with Silicon Valley Bank and our competitor. In 2023, our competitor had $3.3 billion in uninsured cash deposits. Cash deposits are insured in the United States up to $250,000. In Europe are insured to 100,000 euros. If I have $3 billion in a European bank, if the bank fails, I get paid 100,000 euros. I mean, that is a big problem as a stablecoin issuer. So think about it. Let's say that my stablecoin in Europe is 10 billion euros. 60% needs to be, because of MiCA regulations, needs to be in cash deposits in a European bank or multiple European banks. So 60%, so it's 6 billion euros. Then you take the banks in Europe can and lend out up to 90% of their balance sheet. So it means that out of those 6 billion euros, 5.4 billion euros are lent out to who wants to buy a house, start a business, take a mortgage, whatever. And 600 million euros remain in the bank. Let's say that there is a big redemption. Stablecoins issuers need to be able to give back the money at any point in time. If there is a big redemption, and let's say that I get asked 2 billion euros tomorrow, I go to the bank and I ask the bank, give me back 2 billion euros. The bank has only 600 million, so the bank goes belly up and I go belly up. I don't want to take that risk. With USDT, I have $130 billion in US treasuries. In 2022, there were traders that tried to cause around a bank on Tether. Tether was able to redeem $7 billion in 48 hours and $20 billion in 20 days. So $7 billion were 10% of our reserves, and $20 billion were 25% of our reserves. There is almost no financial institution that was able to fulfill that. I can do that because I'm over-collateralized, I'm over-reserved, and I want to continue to do so. I don't want to rely on banks that take my money and do whatever they want.
And the Genius Act, what do you like about it? What do you wish it was?
I think that the Genius Act actually is much more conservative than MiCA, so it has much stronger requirements for the reserves, which we think is a good idea. So it limits the number of assets that you can have in the balance sheet, and does not tell you that you have to keep 60% in cash deposits. That is a great idea. Tether participated to the discussions on the Genius Act to make sure that actually was going to be very strong on consumer protection.
What's the downside risk of holding as much as you do in treasuries?
So we hold the average maturity of our treasuries is 81 days. So it's very short-term maturity. Is the best asset that you can keep. We keep a bit of Bitcoin and gold as a hedge. Gold did very well. If tomorrow, God forbids, but there is a huge issue on the treasuries market, gold will spike to the moon, right? So we keep a few $1 billion as a hedge there, just to be even more conservative, if you will, and gold is a super liquid market anyway.
This is a conversation that can drill down to so many things, yes. And it will take forever because you're the star of the show right now, because stablecoin is, as an asset class, is redefining finance. Around the world, there's a lot of initiatives on stablecoins, and you are at the moment the largest issuer of any stablecoin in the world. there's the role of extending the role of the US dollar as a global currency and dominating global trade and global economies. What sense do you make of all the alternatives that are being created? National stable coins, business level stable coins, all of that.
I'm not a big fan of what they're called CBDCs, central bank digital currencies. The issue there is that they can be used in a very dystopic way. We are seeing in certain countries how potentially freedom of speech is limited. That is already bad. But then if you use a CBDC, the government can also shut down and take all your money if you say something that they don't like. I think it's an important slippery slope that citizens need to be aware of. So right now, if you have a credit card, the credit card is being issued by an issuer that is a partner of Visa. So every time you swipe the credit card, that transaction stays between you and the issuer of the credit card. Then, of course, if you do something wrong, the police will come, go to the issuer and ask for information. But on a general level, the information, what your preferences, your habits, stay between you and the issuer, because the issuer has the information, but not the government. So it's a separation between government and money that is always important. It's one of the fundamental parts of civil society. But now, if you have a CBDC, suddenly the government can geolocate you and everywhere in the world and can know everything about you. And so there is not anymore that filter that gives a little bit of privacy to you, privacy that can be, of course, overcome if you did something wrong. But I think that is important because if the government can know everywhere you have been in the last 5 years and knowing what are your interests, what are all the things you are doing, they can start social profiling you. And in my opinion, it's a big problem. It's like I'm a big fan of sci-fi, and Black Mirror is a good TV show that shows how it can go wrong.
Yeah, but over and above that, the reason I started our conversation with a question on regulators is that regulators underestimate the marketing, the infrastructure that they need to invest in to get their rollout. And the CBDC is a dead cost now. We don't even have to discuss that. It's at this point of our conversation, it's a lost cause. You talk about it in the past tense. $175 billion?
Yes.
And $13 billion in profit last year? Gosh, for the sake of time only, we should, this will be the last question, which is, why is IPO an option when you're so profitable?
In this moment, we are not planning to do an IPO, but we are exploring a raise from strategic investors. Tether has a very ambitious strategy that goes much more beyond the stablecoin. So what effectively Tether and USDT achieved is the disintermediation of a lot of the financial system between people and money. We built for the last 10 years technology that can bring this disintermediation to telecommunications, to social media, to other aspects, even energy. So we have such an ambitious plan that we want to align ourselves with the best tech investors in the world to help us to achieve that vision.
Paolo, thank you so much. I'm preventing myself from drilling any deeper. This conversation can go on, but I think we've ticked the boxes for this morning. And really great to catch up with you here.
Thank you for your time. Thank you.
Cheers.
It was great.